Welcome back, ladies and gentlemen, to another episode of Zoomer Economics. Mike here, and if you have been following the channel for the short amount of time that it's been up, you might be able to tell that this has been a very long break for me. It's been over a month since I've made a video, and there's good reason for that. As you all definitely know, things have been really wild in the world right now, and there's a lot of drama and stress that one can get just from watching the news alone. That on top of my personal life, I really just had to focus on myself, my working, and making sure that I can stay afloat throughout these really challenging times. But something that has also come of that is I've changed my methods of investing slightly, and I've also had some pretty good returns from my consistency throughout investing. So what that means, if you take a look at my portfolio here in Robinhood, you can see that when I started, the growth was very gradual because I was putting in consistently a small amount. And then eventually coronavirus came and it knocked us way down. At my lowest, I was down about $250. At the time, that was a very large portion of my portfolio, so I was really hurting from that. But as we look at it now, you see that the bounce back that I've had and that many other people have had is really strong. We saw some pretty good hits back down, but at the moment we are way up. The portfolio's value at the moment is $8,422. And if you've seen my last portfolio update, I don't even remember what it was, but it wasn't even close to this. And I didn't think that I would ever be able to get this much money, let alone in a investment portfolio. So I'm really happy about that, very grateful. But you can also see that I have a almost $1,200 profit. That's 15% in less than a year. So things are going off right now, and there's a lot to be gained, and I'll show you how I was able to tap into those by changing my investment strategies, and overall I'll give you my opinion on if this is something that you should be doing as well, looking at it from a beginner's point of view. Okay, so the first thing you can see is that my list of stocks here has gotten very long. There's I don't know how many. I haven't even actually counted. Wow. So I actually didn't know the number. Some of these are actual companies, some of these are ETFs, but in total I have 25 different positions. So as you can see here, at the top of my page, I have my total portfolio value, stocks and options. I have no options. I don't do options trading at all, and I don't recommend that you do. I know many people that do, and I know many people that have a very skewed idea of what the stock market is because they get into options, which is the most risky thing of them all. And we'll talk a little bit about my personal risk later. Cash, $2, not much. That means that all of the money that I have is invested in something. If we move down here, we start, and it looks like it's already in order of equity, which makes sense because we have Tesla at the top. Actually, no, it's in order of total return, which is cool. Sure, we'll do it in that order. Tesla, as you can see, I have just a little bit more than a share of Tesla, and that is at $1,451 per share. Now, that is taking up a large portion of my portfolio. Let's see what the actual number is. So this is almost 18% of my portfolio, this one stock. And if you know anything about Tesla, I also am very bullish on Tesla. I see Tesla going way up. My actual equity is very similar to my cost. So if we look here, my cost per share is just over $1,000. That means that my total returns are almost $450 on this one investment, and I've only had it for a short amount of time. Tesla, as you know, is just booming and doesn't seem like there's any sign of it stopping. A lot of people are very skeptical, and me personally, I am super bullish on Tesla. I'm not going to go too much more into that because there's 1,000 people on YouTube that can tell you a lot more than I can. The only thing I know is that I am definitely going to be putting more money into Tesla. Moving down, we have Microsoft. Microsoft is a very surefire way to get some good gains. My actual returns are very nice. I had a little bit more than 2 shares at one point, but I actually sold off a little just so I can move it towards other investments. But overall, Microsoft I'm still very bullish on, and I think you should be too. There's a lot of stuff that can go on. As far as the TikTok deal, the only thing I have to say on that is I don't care about TikTok. I know that TikTok is a very popular app, but what it has to offer is mostly something that Facebook can very easily compete with, and they already have with Instagram. Instagram is already ramping up their video editing abilities, which is all it really takes. TikTok is perfect for memes. Vine was perfect for memes. If Instagram can bring up their meme game, then they have a good thing going for them. Microsoft purchasing TikTok can definitely be okay, but I don't see it boosting the stock price very much, but I definitely see Microsoft continuing to climb, and it's done well for me. Nvidia is another company that is guaranteed to climb, mostly because they have kind of a monopoly, not necessarily a monopoly, but they have a very, very strong control over the graphical processing game. I have a little bit more than a share, and it's done pretty well for me. I want to put more into Nvidia because I definitely see it going well over 500, possibly even close to, I don't know, 750. I'm very bullish on Nvidia. Facebook, very bullish. I think that Facebook is going to climb way more than where it is right now, definitely close to 500 easily sometime soon. That's mostly because they own Oculus. If you don't know anything about Oculus, they have a lot to do with virtual reality, and they've been doing some amazing stuff. I personally work with a lot of Oculus software developing and stuff like that, so I know a lot about these products. They're fantastic, and they're definitely leading the game, especially as far as ability to take losses. So don't underestimate Facebook. Facebook is definitely going to be going up in the same way that Apple is going up. Apple, we all know everything about Apple. We all know about iPhones and the battle between iPhone and Android and stuff like that. No matter what, I love Android. I've had an Android. I actually have a Samsung phone. But despite being a complete Android fanboy, I very much believe in the company Apple, especially after hearing rumors and, just deducing it myself, getting into AR and VR. I think Apple has total ability to not only jump into that market, but really refine the consumer augmented reality products. So if they put out a pair of glasses that can interact with your watch in some kind of Ben 10 fashion, like your Tony Stark, it's totally possible. We have the technology already. All we need is a consumer-friendly product that is well refined, and that's exactly what Apple does. Right now, they already saw a pretty good shot up, so hop on that ASAP, because once people start pricing in that, it's going to go way up. I see Apple taking a really big jump very soon, and only over time is it going to get even better. Now here we get to SPHD, and I'm also going to include SPYD in this topic. These are both the most highly paying dividend companies that I have. I like SPYD more. That's why I have a few more shares than SPHD, because SPYD pays a higher dividend yield. But overall, they both have a pretty similar amount of money into it, 400 here, 525 here. It's just for dividends. They're pretty cheap, and I see them going up. They have a lot of room to grow, especially SPYD. If we look at the 1 year, they're way down, and I totally believe that we're gonna come back up to where we were before eventually. Maybe not now, maybe not in a couple of 2-3 years, but I definitely believe that SPYD, SPHD, they're gonna come back in the same way that this one here, TWO, Two Harbors Investments, they're a financial company. I have a good amount of investment in them. I have 51 shares right now, and they have been pretty consistently moving sideways. which isn't bad. There's a lot of belief as far as the analyst goes. Their dividend yield is 18%, which is fantastic, but also something that you need to be wary of. I've looked at the financials of this company, and it just seems like they're probably not going to go under because of coronavirus. I believe in them. But this is just one of those things that I've put my faith into. I don't necessarily recommend you doing it, but definitely take a look at it. If we look at their financials, if we look at their performance in the past for the 5 years, they've actually been pretty damn consistent. So even if they stayed down where they are, I purchased really low. My average cost is $4.60. So that is pretty much close to the bottom. So yeah, I don't see too much happening with that. As long as I keep getting my dividends, then that's a big winner for me. Same thing goes for VNQI. That is another company in the same exact position. I don't see real estate ETFs going completely under, and this is also a pretty high dividend yield of 8.4%. So I believe in this holding where it is. My average cost of 42 is pretty much on par with where it is right now. So if it does go up, I'll be very happy. If it stays going sideways, then so be it. Let's try to speed through this a little bit more. Square and PayPal, those are two companies that I definitely highly recommend, a lot more than any bank. A lot of people are putting money into banks because Warren Buffett is putting into Bank of America. I personally don't want to put into Bank of America. I've done it twice, and I've gotten very, very little return. It's a long-term stock. If you're going to be putting money in there and leaving it for years, definitely, go ahead. I actually don't want to be putting money into there because I want not only the dividends, but also the growth. PayPal and Square both have a lot of room to grow, but they don't have dividends. So if you want to make that decision between Bank of America and JP Morgan versus Square and PayPal, they're kind of two coins on two opposite sides. One is growth, Square and PayPal, and the other is dividends, which is Bank of America and JP Morgan. So you choose. I obviously chose Square and PayPal, and I've seen some pretty good returns in the very limited time that I've had them. I only have a little bit more than a share, so I'm definitely going to be putting more into that. Google, we all know Google. I love Google. I have so much involved with Google through my professional career that it makes sense to have some money in them. I have $313. I don't really plan on putting much more into that right now because I don't see them growing and their dividend is practically nothing. So I just have the money there just because. I got it when it was pretty low. So yeah, that's that. McDonald's, I don't even want to talk about it. McDonald's has seen some bumps and hiccups and stuff like that. And overall, it's been okay. I've been getting dividends. And I believe in McDonald's, so that's another one in the same case as Google, where I just have it just because. Same with Procter & Gamble. I skipped over PSEC. Prospect Capital, very, very similar to VNQI and TWO. They're low now. They're staying sideways. I believe they'll go up. PSEC pays a very, very good dividend. But going back to it, Procter & Gamble, I believe in them. They've been around for 1 billion years. I don't think they're going away anytime soon. Just like waste management. We all have garbage. I'm garbage. But we need somebody to take care of our garbage. So that's what they've been doing. They've grown a little bit. This is how much it was when I bought into it. This is what it is now. Sure, thank you for that. I don't see myself putting very much into that now, especially because their dividend yield is only a little bit less than 2%. That's fine for now. Adobe isn't going anywhere. I love Adobe. I really, really think everybody should believe in Adobe. They've gone up a good amount, but I see them going way up. So I'm going to be putting a lot more into Adobe, especially for the long run. I don't see anybody coming close to touching Adobe. Just like Amazon. I have very little amount of money in compared to what the stock price is. I'm not going to be putting $3,000 aside just for Amazon. If I had $3,000, that would always, hands down, go straight toward Tesla. Amazon obviously is growing. I want to get in on some kind of piece of the pie. I'm not really too keen on putting money into Amazon right now. I think that they've probably reached a little bit of a ceiling for now, especially with all of the eyes on them for government and antitrust and whatever else Google, Amazon, and those big guys are going up against. But I think Amazon is the one that's really getting the most attention and has the highest possibility of seeing a pretty big sell-off. Is it going to last forever? No. But right now where they are, I'm just going to leave it. NLY, same exact thing as those other financial companies, just dividends. Realty Income, another example, mostly just dividends, not much growth. Pretty happy with it so far. Now, I'm going to skip ARK so we can say Johnson & Johnson, dividends, slight growth. Teladoc, that is a healthcare online company, growth. Are there dividends? No dividends. So this is mostly growth. If you look at their growth, it's been very steady. So Teladoc Health, definitely something that is good for growth. They recently, in the past week, have seen some really hard hits. So I bought it while it was pretty low. Average cost $203. It's still going down. So I'm going to call dollar cost average by tossing in more money. And, by the time it actually goes up, hopefully that will be a pretty good bag. Same with Fastly. This is a cloud computing company. They have a lot of stuff to do with just online. And right now that's a pretty big business. Now they have seen a pretty big dip. If you look at their growth, it's seen some really big jumps, especially here. Right now there's been a pretty big sell-off, so we'll see if that comes back. But right now I actually just plan on putting in more money into Fastly. So I'm pretty bullish on anything cloud computing, and I think you should be too. Geo Group, don't recommend it. Going based on a friend's recommendation because of the dividend yield. The dividends have been consistent, they have been paying out. However, the cost has been fluctuating a lot. That's a risky play that I don't really recommend. Last thing I want to talk to you about is ARK Innovation, ARKK. Highly recommend it. I'm very bullish on it because they take advantage of all of the tech stocks that are booming. And if you know anything about Cathie Wood, who is the leader, she is pretty much the Elon Musk of investing, in the sense that she knows what to look for. She knows how to look for growth, potential growth, and I just implore you to do a lot more research on Cathie Wood and ARK Innovation. Right now, ARK is at $82. When I bought in, it was at $81. It's been moving around a lot because people are hearing about all the buzz. It shoots up, there's a huge sell-off, and it goes right back up again. There's, if we look at the 3-month, you can see that it's just consistent growth, and I don't see this stopping anytime soon, especially with the way that tech has been booming with cloud computing, with automatic driving vehicles, with EVs. ARK Innovation is positioned to take advantage of that highly. And if you believe in the technology of the future, then you should also believe in ARK Innovation. Cathie Wood is a very, very smart woman, and I love just listening to what she has to say. I hope you enjoyed listening to what I have to say about my portfolio. The main takeaway that I want you guys to have here is that, yeah, we will have a couple of down days here and there. But as you can see, overall, I have seen some very healthy gains. And I moved a little bit away towards my initial dividend investing strategy because I wanted to take advantage of all of the growth going on with tech. So I think you should do the same thing. Do more research on the companies that I've brought to you today, and just know that my portfolio is pretty diverse. There is a lot of pressure to sell right now. There's a lot of pressure for me to just completely sell out, take my profits of almost $1,200 now and let it be. And is really taking a lot of determination to not do that. So I really hope that you can see that I'm trying to lead by example as far as consistently investing. I have been consistently putting my money in, and I have really been trying to spread it out as much as I can, diversifying. I have a very wide list of companies here, but I'm still underrepresented in a couple of different things like food, pharma, and healthcare. So, and I don't have anything energy really. You can't really consider Tesla that at the moment, but like I said, there's a lot of stuff to look at, and diversifying is what's really going to help you out. And I think that I've diversified pretty well for the current climate we're in. Harping back to the beginning of why I created this channel, I wanted to prove not only with words, but also with actions that it is definitely possible for somebody with no experience to get into some kind of investing. And I've only built up this confidence by watching other people on YouTube. So I hope that by you guys watching me go throughout my trials and tribulations, it can make you want to maybe take a little bit more control over the future of your money and your financial situation, and try to start growing your money. That's exactly why I got into this, and I hope that it is also pretty clear that I try to stay consistent. Consistency is really the name of the game, and it's also about not getting too caught up in the days that things are down. And the best example of that is coronavirus right now. The situation that went on brought the markets down by 30% in some cases, sometimes even more. And when that happened, that was when I had just started. So it really, really hit me. But now where I am, I'm way up. And there is definitely room for me to fall down again. There's room for all of us to fall down again. If the market were to tank one more time, it's probably going to be more than 30%. And with the way that everybody's talking, it seems really scary. Things are constantly moving up now, and you might get that fear of missing out. You might also feel like if I put in now, it's probably just going to go down because I missed the rush. And you're probably right in some cases. But with the way that tech is moving, I see that there's a lot of opportunity for continuing growth, despite whatever the economy looks like. And it's pretty clear that the overall economy is the overall economy is very detached from the stock market. I don't know when the stock market is going to realize that record high unemployment, as well as plenty of companies going bankrupt, people not even being able to open their doors. I don't know when they'll realize that that is really, really bad. That on top of what the government has been doing to intervene with this, you might be receiving another stimulus check. And I didn't even think it was going to happen, if I'm being honest with you. I kind of felt like the government was just going to give up on us. And they're going to have to give up at some point. When that does happen, things are going to have to be all on us. The unemployment that was going out to most people, the extra $600 had ended already. So by the time I'm making this video, that's already over. They're saying that it's going to come back, and I don't even pay attention to that stuff anymore because I don't feel like the government is really going to be enough to help us. There's a lot of people who are in really shitty situations, and there are a lot of people who need to be taking things very, very carefully right now. I am very fortunate to be in a situation where I can play things extremely risky, and that's exactly what I'm doing. And this is why I said risk is something that's extremely important to be able to understand, and not just understand what risk means, but to have the experience and to understand and build a tolerance for risk. So me, I've been putting money into different companies. I've learned when and when not to, and how to identify signs of a company that's going to either be going up or going down. Obviously, I'm not perfect with it, otherwise I'd be a millionaire by now. But I've gotten a lot better. Some people have a really hard time understanding all of the different variables that go into the economy. Or I shouldn't say the economy, the stock market. But Anybody with a financial head on their shoulders will tell you that you need to have an emergency fund. Just in case something goes wrong, you need to have money, cash on hand to try to cover your ass. And you can do that with credit, but that's a really bad situation to put yourself in. So you need to have cash, most people say. But for me, I have hardly any cash saved up. I only set on about 1 to 2 months of expenses at a time. Sometimes a little more, sometimes a little less. It just really depends. But I like to have as little cash on hand as I can survive with, and then put all of it into somewhere where it can be growing. And if you look at my investments currently, that's 15% gain. That's money that I didn't have before, and if I had that money in cash on hand this entire time, I wouldn't have gotten. So the amount of effort, the amount of risk that I take on and put into the portfolio pays off. It might not be an entire second job, but it's not going to require the amount of effort that a second job would. I'm not day trading. I'm not putting money in and then immediately pulling out. That's not what I'm here for. I am looking for consistent growth, and I'm also looking for dividends. Dividends was my priority, but at the moment I am taking advantage of the current situation so I can try to get some good gains. If I were to pull out and try to realize those profits, then I would have to pay the taxes for it. Don't get caught up in trying to scam Uncle Sam, because it's not going to work. I know that this is money that I really shouldn't take out, but if I have to, there's going to be some kind of penalty for that. And if I remember off the top of my head, I'm pretty sure that's going to be about a 15% tax. So if I wanted to pull my money out right now, I would see a whopping 0% profit. So obviously I don't plan on taking my money out right now. The money that I have in my portfolio would be enough to keep me going for maybe about 6 months, so close to even 7. That's a great amount of money to have in an emergency fund. But if it's in an emergency fund and you don't have any money working for you, then you won't see any profit. The profit really is there to try to keep you up with inflation. And that's the one thing that I'm not going to dive into right now. Inflation is going to happen, and we're going to lose purchasing power. Our dollars aren't going to get us nearly as much, thanks to all the money that's been poured into the economy from the government, as well as just the wild situation of these big companies, as well as these tiny guys being taken out by this pandemic. So we really need to be cautious about what's going on out there. We need to put our money where it can be best suited for us. Right now, the money works best for me in my portfolio, because I know that I'm going to see some kind of profit from that. If I held it on hand, not only would I have to stop myself from touching it, but I would also be missing out on any kind of opportunity to have it grow. So right now, my risk level is way up there. I still haven't completely diversified my portfolio to the place where I want it to be, so I am still really sticking my neck out there. But we'll see how that works out for me, and I definitely want you to be along there for the ride, so make sure you hit subscribe. Please give me a like on this video. Go check out my other videos. They're very much just like this, and you can go back in time a couple of months to see how this all started. So thank you for spending the time with me. Thank you for listening to me, and I hope I was able to give you some kind of value. Definitely plan on more coming in the future. The portfolio is definitely going to be growing, and I hope the audience will grow with it as well. I will see you in the next video. Bye-bye.